We've all been there. You have your eye on something expensive, maybe a sleek, premium new laptop, but you refuse to pay full price. So you wait. You check the store page every week, hoping to catch a sale. Let's say this specific laptop costs $1,000, but you've looked at your personal budget and decided you are only willing to spend $900. Until it hits that price, your money stays in your pocket. Now, imagine the store manager walks up to you and offers a strange deal. He hands you a $20 bill today, right on the spot. In exchange, you sign a binding, written promise that if the laptop drops to your $900 target within the next 30 days, you will buy it. If 30 days pass and the laptop never goes on sale, your written promise simply expires. You keep your $900 budget and you walk away with that free $20 bonus. But if the price does drop, you fulfill your promise and buy the laptop for $900. And because you already pocketed the manager's $20, your true out-of-pocket cost is actually only $880. It sounds like a specialized arrangement, but this exact setup, getting paid a fee just to wait for a lower price, happens every day in the stock market. It's a strategy known as a cash-secured put. Let's translate our laptop story over to the stock market. Imagine a company called Stock XYZ, and its shares are currently trading at $100 each. You really want to own part of this company, but you think $100 is too expensive. You've decided $90 is a much safer, fairer entry point. Options contracts bundle shares into batches of 100. To buy 100 shares at your $90 target, you need $9,000. This is the cash-secured part. You take that exact $9,000 from your brokerage account and temporarily lock it away. Setting this cash aside protects both parties and builds a necessary foundation. With your cash secured, you place the trade. Looking at this typical brokerage screen, the action you take is called selling a put option. When you type in your $90 target, you are officially setting what the market calls your strike price. The moment you submit that order, you receive your reward. The market pays you an upfront fee, called a premium. Let's say for this trade, that premium is $200. That cash is deposited directly into your account, and it is yours to keep regardless of what the stock does next. If stock XYZ stays above your $90 strike, the contract expires. Your $9,000 unlocks, and you keep the $200 premium. But if the stock drops to $85, you must buy 100 shares. Factoring in your $200 premium, your true cost is just $88 per share. The strategy delivers exactly what was promised. You either generate a stream of cash while you wait, or you end up owning the stock for even less than your original $90 target. To understand this strategy fully, we have to look at why it isn't a perfect solution for every situation. There is a very specific risk involved. Here's the worst-case scenario. Catastrophic news hits, and stock XYZ crashes down to $50 before your 30 days are up. Your contract is binding. Even though it's only worth $50 today, you're legally forced to buy 100 shares at your agreed-upon $90 strike price. The danger of a cash-secured put isn't that you can rack up infinite debt. The danger is that a stock plunges, and you are trapped in a contract that forces you to pay significantly more than the current market price for a sinking asset. To manage that risk, successful traders follow one core principle. Only execute this trade on high-quality companies you genuinely want to own for the long term. Your strike price has to be a number you are truly happy to pay, so that if the market panics and the stock drops, you are perfectly content holding those shares in your portfolio. This is a disciplined approach to the market. It's about patience, not speculation. By mastering the cash-secured put, you stop passively watching the stock market hoping for a discount, and you start getting paid to set your own terms.